We are diving into a really comprehensive analysis report today, and it's all about Tesla. That's ticker TSLA, of course.
Of course.
And the market is really reacting to the latest short-term delivery numbers.
It sure is.
But the analysis we're looking at argues that all this noise is just completely obscuring the real story, which is the 2026 robotaxi revolution.
Exactly.
So our mission today is to figure out why this report believes Wall Street is, well, fixated on completely the wrong quarter.
And that fixation was very loud this week. If you were watching the market, the stock closed down pretty significantly.
It did. It ended at, what, 438.07?
That's the one. And the immediate reason, the catalyst, was all these media reports just screaming about a Q4 delivery miss.
Okay, so what were the actual numbers?
They came in at 418,227 vehicles delivered, and that fell just short of the 440,000 that Wall Street was expecting.
So a classic case of bad headlines driving the price down.
It really is. It's the market looking directly in the rearview mirror.
And the analysis we're digging into, it really frames this whole drop as just a temporary distraction.
My classic shakeout.
Right, a shakeout for investors who, panic over these quarterly ups and downs.
Precisely. And if you connect that to the real narrative in this analysis, it's that the short-term delivery stuff, which is real,
Sure.
It's just blinding analysts to the exponential growth that's baked into the future of the business.
Yep.
The report's core idea is simple.
Which is?
Wall Street is focused on yesterday's car sales, and they are completely missing the boat on tomorrow's robotaxi empire.
I really like that separation, that idea of present versus future. So, okay, if the long-term story is so strong, we still have to look at the immediate reasons for that softness.
We do.
Why did those Q4 deliveries fall short? Was it, I don't know, internal manufacturing problems?
The analysis points pretty overwhelmingly to external factors. It's not an internal failure.
So the macro environment.
The macro environment, exactly. The biggest headwind right now is just high interest rates.
Mm-hmm.
I mean, globally, central banks have hiked rates to fight inflation.
And that's hurting the entire auto sector.
Absolutely. It's pinching the whole sector. Cars are, they're big ticket items people finance. And when borrowing costs go up, demand just naturally softens.
So the delivery miss is really more of a reflection of a general cyclical slowdown in the car industry, not some unique problem at Tesla.
That's the interpretation. And the analysis argues that this is where the stability part of the company becomes so important.
How so?
It's structured to weather these cycles better than, say, a traditional automaker, because it's not just an auto company anymore.
Which brings us right to that stabilizing factor the report mentions, Tesla Energy. So if auto sales are fluctuating with interest rates, what is the energy division doing to keep the ship steady?
Well, this is what's so fascinating. Tesla Energy is acting as a genuine financial buffer. While the auto sales were facing those macro headwinds, the energy division reported nearly 50% growth in deployments. This is not a small side project anymore. It is a growing cash cow.
When you say energy division, what are we really talking about here? It's not just solar panels on roofs, is it?
No, it's far beyond just solar. It's the power walls for home storage, sure, but the really big piece is the massive megapacks for utility-scale energy storage.
And what do those do?
These things are being deployed all over the world to stabilize electrical grids. They help utilities manage, renewables like solar and wind that aren't always on.
So it creates a steady, predictable revenue stream.
Exactly. High-margin, predictable revenue from utility contracts, which is the total opposite of the volatile consumer car sales cycle.
Okay, so the auto business funds the R&D, and the energy business is the shock absorber for when the economy dips. That makes sense. But it brings us to the elephant in the room.
The valuation.
The valuation. It is a massive question.
It is the core valuation trap. If you look at the stock today, the PE ratio, based on the last 12 months of earnings, is around 293.
Which is astronomical for a car company.
For any mature company, really.
Mm-hmm.
And most of Wall Street sees that 293 number and just immediately labels the stock as impossibly expensive.
Right. They're pricing it as a car company.
Exactly. But the analysis argues if you step back and you view this not as an auto stock, but as an emerging AI monopoly.
An AI monopoly.
A company building the sort of operating system for autonomous mobility. Then that price suddenly starts to look, well, maybe even cheap. The market is measuring apples and oranges.
So let's just break that down one more time because it is so vital. The report says the auto business is just the funding mechanism for the real AI business.
That's the thesis.
Yeah.
And that dynamic really only exists until the true shift happens. The Model 3 and Model Y sales, they generate all that cash.
That $4 billion in free cash flow we'll get to.
Right. That cash directly funds the R&D and, more importantly, the data collection to perfect the full self-driving platform.
And that platform is what enables the robotaxi.
That's the key.
So if car sales are just the means to an end, we have to talk about the end itself, the Cybercab. This is the big inflection point. And the report points to a very specific time frame.
It does. The critical catalyst date that's emphasized over and over is April 2026.
April 2026.
That is the rumored, highly anticipated starting line for Cybercab production and the initial rollout. This is when the business model stops being about selling hardware and starts being about selling transportation as a service.
Let's just pause on the vehicle for a second. The Cybercab, it's designed without a steering wheel, without pedals. Why is that so important? It sounds like a detail, but the report treats it like a revolution.
It is a revolution. And the report breaks it down into 3 massive economic advantages.
Okay.
The first one is margin generation.
Yeah.
It's a structural change. When Tesla sells you a Model Y today, they make a profit, but it's a one-time thing. That revenue stream ends.
So it's finite cash flow from one sale versus perpetual cash flow from a service.
Exactly. With a Cybercab that's out on the road, the company generates recurring revenue every day, every hour, for years. They're monetizing the use of the asset, not just the sale.
And the margin on a service model is just inherently better.
Inherently superior to manufacturing.
Okay, that dramatically changes the potential income scale. What's the second advantage the report highlights?
The second is a staggering reduction in manufacturing cost. This is where getting rid of the driver controls pays off massively.
Oh yeah, how much can that save?
Think about it. You take out the steering wheel, the airbag, the dashboard, the pedals, all the wiring for those controls. It just simplifies the whole build.
So what are the numbers? How big is the reduction?
The report estimates that the manufacturing cost will drop significantly. It could potentially fall to under $25,000 to build a Cybercab.
Under $25K.
When you compare that to a current vehicle, it's incredibly efficient. A low-cost structure plus a continuous revenue stream is the recipe for total dominance in ride-sharing.
That is impressive. But it brings us to the third advantage, which the report calls the moat. And I want to play devil's advocate here.
Please.
Every big tech company, Waymo, Apple, Cruise, they're all working on this. Why does this analysis assume Tesla gets an AI monopoly? What makes their moat uncrossable?
That is the critical question. And the analysis argues the moat isn't built on just having better algorithms today. It's built on data.
The quantity and quality of the data.
Right. The report emphasizes the real-world miles being driven right now by millions of cars using supervised FSD. They're generating data at a scale that no rival can even hope to match.
Okay, we need to define supervised FSD clearly here. Why is the fact that it's supervised so important for building this moat?
The supervised part is the genius of the whole model. It means the human driver is still there, paying attention, ready to intervene.
Okay.
And every single time that human driver takes over, or even when the AI gets something right in a tricky spot, that data, that labeled high-quality data, gets sent back to the neural network.
It's a feedback loop.
It's a massive, continuously self-improving, real-world validation loop. Competitors might have a few hundred test cars. Tesla has millions of customer cars acting as a global data collection fleet.
So the millions of cars on the road today are effectively unpaid data collectors, validating the future robotaxi network.
Exactly right. It's a data flywheel that just spins faster and faster over time. And to make this concept easier to grasp, the source material uses the perfect analogy.
Which is the Apple moment.
The Apple moment.
I love that comparison. Tell us how the report connects the Cybercab to Apple's big transformation.
Well, think back to the early 2000s. Apple was selling hardware, the iPod. It was a great product, but it was a one-time sale.
Right.
Then they launched the iPhone. And the iPhone wasn't just better hardware, it was the key to the App Store. Apple shifted from selling a product to selling a high-margin recurring service and software platform.
And the report says Tesla is doing the same thing.
It's a mirror image. They're moving from selling hardware, which are the cars, to a software service model, selling the rides themselves. They're not just building a better car, they're building the operating system for the future of transportation.
That really frames the scale of this change.
Okay, let's switch from the tech and the vision to the financial side of things. This whole pivot has to cost a monumental amount of money.
It does. But Section 3 of the report highlights what it calls a financial fortress.
So they're not scrambling for cash.
Far from it. The analysis points to incredible liquidity. They reported $4 billion in free cash flow in the last period, and they're sitting on a huge pile of cash.
How much?
$41.6 billion on the balance sheet. That cash gives them a huge cushion from any macro downturns and, crucially, the ability to fund the entire Cybercab rollout without needing to raise more money.
So they have the cash today, but the whole valuation debate is about the future. Right now, the market cap is around $1.37 trillion. How does the analysis justify the huge numbers being thrown around for the future? By focusing purely on the unprecedented leverage of the robotaxi model, The bull case for 2026-2027 looks at the global transportation market as a whole.
Okay.
And the calculation shows that if the robotaxi service captures even 1% of the global rideshare market, just 1%,
Yes.
analysts see a clear, defensible path to a $3 to $4 trillion valuation.
Wow. So capturing just 1% of that market could triple or quadruple the company's current value. That's the power of that recurring high-margin software model we talked about.
It really shows the sheer scale of the disruption they're modeling. You're
Yeah.
talking about moving from the size of the auto industry to the scale of global transportation infrastructure.
Yeah,
1% is the key.
So while that $3 to $4 trillion number is the long-term ceiling, let's bring it back to today for our listeners. Are there any specific near-term price targets in this analysis?
Yes. The report often references existing targets, specifically Stifel's price target of $508, which provides a near-term anchor. So if you look at where the stock is trading right now, around $438, it means it's at a pretty significant discount, about 16%, to that professional target, even before the Cybercab is a reality.
Okay, so if we bring all this analysis together, the conclusion is basically that the $11 price drop we saw is just a temporary disconnect,
A moment of noise.
and that long-term believers see this dip as a gift, a chance to buy in at a discount because of temporary macro factors.
That's the summary, yes. The delivery miss is a short-term issue tied to interest rates. But the exponential growth story, the one built on the Cybercab and the AI moat, that's entirely intact.
The market is overreacting to the present and ignoring the near future.
Exactly.
So for listeners tracking this, the report gave a very specific, actionable insight on support levels. Now that the stock hit 438, what's the critical line to watch?
The report specifically points to the critical support level at $435.
$400.
That is the near-term line in the sand. If the stock holds that level, the analysis suggests the noise is probably absorbed, and we should expect a quick bounce back towards 460 as the focus returns to the Cybercab story.
That gives you a very clear way to interpret the price action over the next few weeks. The macro environment is setting the price today, but the tech transformation is what's setting the valuation for tomorrow.
And it all comes down to a fundamental question that the analysis poses at the very end.
And what's that?
Do you believe in the future of autonomous driving? If you answer yes to that, then the narrative here suggests this $438 entry price is tied directly to that April 2026 Cybercab date. You're not just buying a car company, you're buying a piece of the future operating system for global transport.
It's a compelling argument, a really comprehensive look at why a small delivery miss might be the least interesting part of a trillion-dollar company's story. The focus is clearly on that runway to 2026. So what you need to ask yourself is, if the cost to build a transportation asset drops to $25,000 and that asset generates revenue for a decade, how fast will that change every city on the planet? That is the disruption you're investing in.